This week on the Wealthy Pilots podcast, target date funds. Are they good? Are they the easy way? Let's talk about it. Let's break it down. Let's get some insights from Scott here on the program. Let's get going.
We've got some turbulence up ahead.
Hey everybody, welcome into the podcast. Thanks for hanging out with Scott and I here on the Wealthy Pilots podcast. What's going on, my friend? Well, you and I were just laughing about how we're underwater for like the last week. But you still swimming?
Yeah, I am just not in my pool. I mean, it's been raining nonstop up here in Ohio. I saw something online the other day. It was like, you need to check on your friends in Ohio. They are not okay right now, and it is.
I think it's the whole Eastern Seaboard. It's been like crazy.
It's been a tough spring. So, but
so
looking
far.
at the forecast, I think we're almost through it. So we will have spent all of May, I think, in the 50s, and we're going to jump right in the 80s and just skip the 60s and 70s. So
just gloss right over it. That's right.
Yeah, exactly.
Well, let's get into our conversation today, my friend. Target date funds, they exist for a reason because they're easy, right? A lot of people just, you take a job and I don't know what to pick. I'm not an advisor. I'm not a financial person. I'm going to retire in 2040. There's a 2040 fund that works for me, right? Cool. Just FYI, by the way, they just hit $4 trillion in assets, according to Morningstar. Target date funds, $4 trillion. So what is a target date fund for our folks who might not know, and what's your thoughts?
Yeah, so just kind of, I guess, maybe giving it a little bit of a definition. The target date fund is just it's a mutual fund that is based off of certain asset classes that is meant to mirror a risk profile for a certain investor. Like you said, hey, if I'm going to retire in 2050, I got 25 years to go here as we record this in 2025. Let me invest in that, pick that one fund, put all of my assets in that one fund, and then the fund will slowly every year reduce the exposure to stocks and increase the exposure to bonds automatically without you having to go in and rebalance it or change the portfolio. And so for again, somebody who has no interest in either hiring it out or no interest in doing it themselves, it's better than your money going in and just
absolutely
cash.
Yeah.
And honestly, if you look back at the history of 401ks, when a plan was developed and a new hire would come on, it used to be your money would go to cash until you picked what you wanted to go to. Mm-hmm. But you get enough 401k, plan administrators who get sued for breaching their fiduciary duties, because to let an investor just put their money in cash is not really being a fiduciary. And so now these target date funds are just the default option. And so, based off,
and it's easy, right? It's that low hanging fruit. I mean, why monkey with it, right? It's like, just pick that fund and roll.
Well, and I think a lot of times it's not even anybody picking the fund. It's just the default option that, hey, when you get enrolled in the 401k plan, it's going into this fund based off of your age.
That's
and then if you want to change it, log in to change it. And then many times people will say, hey, actually, based off my age, I'm going to retire in 2060, not 2050. So they'll make a change there. So they're changing maybe from one fund to another, and something we frequently see is they might diversify across multiple target date funds. Well, that doesn't really... I mean, they're all owning the same thing. It's just a different.
Yeah, I was gonna say it doesn't do anything,
really
right?
Diversifying anything, but
yeah,
in essence, I mean, that's what it is. And so, there's like any strategy, there's upsides and there's downsides to it. I know Vanguard just put out that 8 out of 10 Vanguard 401k investors have a target date fund. And so, they're not inherently bad. It just depends, like, what are your goals,
Yeah. Well, let's talk about the benefits and the catch a little bit, right? So, the benefits, clearly it's super easy, right? Yep. I mean, that's just first and foremost. The built-in rebalancing you mentioned, that's easy as well. But I think one of the catches is you talked about the risk, it pares down the risk, right, as we get closer to the target date. There's a big misnomer there that people think, I picked the 2050 fund. You went with that one. We'll say that. Every year I get closer, it's bringing the risk down until it gets down to, whatever. Most of the time, these don't really drop below 50%. So I think that's one thing that people don't realize as well. Often they stop at a 60-40 portfolio split too. So,
well, to me, I think where you tend to miss the mark with the target date fund is it doesn't take into account like your personal plan and your goals.
Oh, no.
And your tolerance for risk or your desire for returns. Again, it's the default option. So I like them because it's not the default option is no longer, it's just going to cash. And so this is significantly better than you going into a stable value fund, which many government plans still the default option is to go to a stable value fund. And then, you got to rebalance out of that. And so, those days for a lot of these, corporate, especially in our airline 401ks, they're not doing that anymore, which is good. So it's much better than it going to a stable value fund. However, when we look at the risk profile of many of our pilots, executives, some of the crew that we're bringing on, I mean, they have a desire to get better returns. And so maybe they have, a higher tolerance for risk. Hey, I'm willing to see some more volatility up and down. If we're going to get it on the upside, a lot of times it means we get it on the downside when the market's bad too. But many people are willing to endure that to get that better long-term return long-term. But the target date fund's not going to let you do that. It's got a very specific parameter of what their tolerances and their balances are going to be for stocks and bonds, and it's going to follow the plan. And so, that aspect of it, I think, can definitely, have your investments. Many times, most of somebody's 401k is in these target date funds. And so you got, the 401k tends to be the largest retirement asset. So you have most of the assets for most of the, assets for that person that's retiring that are not really align with the objectives of the investor. And so that misalignment, I think, leaves some opportunity for us to improve for sure. The other side is that, when we look back, when we're working with our folks that are building this bridge to retirement, a lot of what we talk about is like, hey, we need to have like a safe pot of money. So we call it the safe bucket. And then we want everything else oriented to growth. We know that the stock market tends to be a positive about 80% of the time, 8 out of every 10 years. And we also know that if in those down years, if we have, 3 to 5 years, I mean, data would tell you 42 months, but we say 3 to 5 years of safe money built up to make sure you're not selling stocks at a loss while that growth bucket is temporarily down, then we can, make sure we never sell stocks at a loss. And then when those stocks come back, we can kind of refill our safe bucket. And that's kind of how we manage it in retirement. It's pretty simple, but very effective. Now, the target date fund, is going to get more and more conservative. But like when you step back, and even if I'm talking to somebody who's 60, especially a pilot, right? They're going to work 5. Well, what do you have planned the next 5 years? Well, I'm going to work. Okay, then we shouldn't be building a bunch of your nest egg in conservative assets. Maybe we get not very aggressive, but at least allocated to stocks and growth for the assets we have. And then maybe our future contributions we have going to something more conservative, and we're building that safe bucket that we land into in retirement. And so, it comes down to like having a plan for you. And if you're a younger person, I mean, you got 10, 15, 20 years left to work. We just don't have a lot of data, like zero data that tells us we want to own a bunch of treasury bills or bonds because those asset classes underperform over 5, 10, 15-year periods pretty regularly. And so, we want to get as much of that, performance tailwind in our portfolio as we can. And the target date fund is not going to let you do that. It's going to make you more and more conservative, regardless of what your plan is.
Yeah, I just saw that that they're actually when they allocate these plans over the last probably 7 years, they're all a lot more aggressive than they were just a decade ago. Yeah. So like their initial layout is all more aggressive as well. And again, that might be fine for some, not for others. And of course, they talk about it as, I thought it was funny, they call it the glide path, right?
Yeah.
So, which goes well with our show.
Yeah.
But as it's bringing its way down. So we'll wrap it up with a couple thoughts here. What's some things to watch out for? Scott, the one thing we didn't really touch on, I think, is the fees. Like you need to talk about the fees a little bit with whomever, look into that because they're often kind of pricey.
Yeah. And it depends. I mean, for a lot of our airlines, the default, target date funds are pretty low cost, and that can be appealing to somebody like, hey, it's lower cost than this, either ETF or mutual fund or actively managed fund or whatever. And so, but you have to cost is multiple things. We have the expense ratio as one cost. You have missed returns is generally what I would say the biggest cost that most people don't even know they're paying. But some folks can get fixated on, well, hey, this target date fund's only 0.2% or whatever the case is, but and maybe this mutual fund is 0.5%. So I don't want to pay 0.3%. Well, you're not buying the same thing, and that's what you have to think about. So maybe I'm paying for a little bit more for something, but what is that index or what is that fund done over a long period of time? And look at track records and look at your goals and your plan first more than anything else, and then figure out if it makes sense to maybe get a little bit more aggressive with what you're trying to do. But you got to look too and say, hey, if I'm going to become more aggressive and then the market goes into some downturn, a month after I make these changes, am I going to back out of it? I mean, hopefully not. Hopefully you're going to have that mindset that's like, no, I'm glad it's down because I'm buying more and more of these assets that are going to grow long-term for me. And so, to me, I think that's where you got to look at your plan first. We can't make all future performance calculations based off of what the past has done, but history is also a good teacher, right? And so, the target date fund, it's not a bad way to get started, but it tends to not align with at least most people I meet, it tends not to align with most people's long-term goals to be willing to take a little bit more risk and seek out those better returns. So ultimately, to me, I think we don't necessarily want to take an active approach where we're constantly buying and selling stuff all the time. We know that tends to underperform. But if we can take an active approach towards our plan and say, hey, here's my plan, and let's get some good investments we can buy and hold for a long time to support that plan. That kind of active approach I like, but just taking the default option, I think is, tends to not be in the best interest of most people that we're talking with.
Well, it's better than nothing. Absolutely. Right. You're definitely doing something positive for yourself. And when you're younger, these probably are a much more appealing option because you're not that invested. You're not that worried about it. You're just pumping in through your job. But I agree with you. As you get a little older, you start thinking, okay, there's some better option. There's some better things I could be doing out there. And that's the case.
For sure. I mean, and again, if I look at, let's take a pilot who's brand new, right? They got $0 in their 401k, but let's say they're going to max it and their airline's going to do their max portion of it. They're going to get close to maxing that 401k at roughly $70,000. So they're going to put 70 in the first year. Then they're going to put roughly 70 in the next year. And, even if the market's up its average of 10%, that's only $7,000. Well, over a year, 2 years, you got, maybe 10 grand of performance in there and 140 of contributions. But I'd say after the first couple of years in there, you start to get enough of a capital base that, man, if I got a couple $100,000 in that 401k, I want to make sure I'm getting the best performance I can out of it, And so, definitely the larger the account balance, the more important it is to have the allocation correct. I mean, if you got $2 million in there and my account underperforms what it should have based off of what my plan calls by 5%, that's $100,000 of cost that I never even know that I just paid. But that is actual money you're not earning that you should be earning. And again, if you look at it like your union contract or, for some of our executives, some of the executive compensation, if you were supposed to be getting money based off of your, performance at work and what you do, and you weren't getting it, you'd probably be pretty ticked about that.
Yeah, exactly.
But over in the portfolio, I don't ever look at it like that because I never, just because of the nature of how it performs and what it is. But, there's times where we should be getting better performance if we had a better plan and a portfolio that matched that plan. And,
there you go.
And if I look at that and I factor in like, hey, I should have gotten that money, that should frustrate you and you should get a better plan and get a better portfolio that is going to serve your plan well. And that's where the target date fund, I think, can leave a lot of people disappointed.
Well, and how can you do that? Well, there's a great way to get started. So check this out if you're interested.
Hey everyone, real quick, if you haven't grabbed Scott's Financial Flight Control Toolkit yet, now is the time. This is packed with tons of helpful resources and tools like this, Scott's book, The Dichotomy of Wealth, which is a pilot's guide to maximizing wealth and cash flow in retirement. You also get access to some great guides like this one, Advice Matters, which breaks down 4 key ways a good financial advisor can help you boost your returns over time. And guides like this one on the pitfalls of emotions when it comes to investing, and this one on the HCM byline investment strategy, and more. So if you'd like your very own financial flight control toolkit, just click the link in today's show description, and Scott and the team will be happy to get one sent your way at absolutely no cost to you.
All right, Scott. So at the end of the day, I mean, again, it's like a lot of things in the financial services world. They're not necessarily a bad idea. They're not a bad financial vehicle, but there could be a better option for you depending on the time of life that you're in, right? I mean, that's at the end of the day, the time of life you're in changes a lot when it comes to financial philosophies.
I mean, a target date has no morals. It's not good. It's not inherently good or bad. It's
right.
It's what are you trying to get accomplished? And most folks I work with, most of our pilots and executives that come in to see us they would like to see the good long-term returns, which many times means they're willing to take a little bit more risk than what the target date fund allows them to take. And so we have to build the plan and then build a portfolio that is going to support that plan and then implement it. And that's, again, where a lot of times the target date fund, it's not bad to just get us started. Our stuff's not going to a stable value fund. But again, the longer you work, the more you're pumping into that fund. Generally speaking, the more off the market it's going to become, and the less it's going to perform for you. On a larger account balance.
And you got a bigger smorgasbord by going out of that too. There's just so many more things out there than what's inside the fund. So if you got some questions, need some help, and again, everything's a little bit different, right? You gotta dig into the nuance, and that's what a financial professional helps you with. So get on the calendar, Scott, have a conversation. We got the links and stuff below, but you can go to retireairlines.com and check him out there. Again, that's retireairlines.com, but the show links or the website links are in the show descriptions below. And don't forget to subscribe to us on Apple, Spotify in audio form, and of course on YouTube. Hit that little subscribe button, thumbs up, and the notification bell so you catch new episodes when they come out and support the channel. And Scott and I would certainly appreciate it. We'll catch you next time here on the Wealthy Pilots Podcast. Thank you, my friend. Always appreciate your time.
We'll see you soon.
We'll catch you next time here on the program.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.